So with my previous two PowerPoints, we've looked at steps 1 through 4 and 6. So there's 9 steps of the accounting cycle. Steps 1 and 2 go together. It's business transactions occur. We generate source documents like checks, bills, invoices, and then we analyze them and record them in the journal. So those are the two things that we looked at or focused on mainly in accounting, part 1 and part 2 to intro accounting videos. And then in the last video, I also touched taking everything from the journal and posting it to the general ledger. And the general ledger is looking at each individual account and how they're affected by the business transactions and the ending balance. And then from those ending balances, we created the trial balance. So that's the only financial statement we've looked at here. Step 6, I discussed the other financial statements, income statement, balance sheet, and statement of owner equity, but we'll look at them a little bit more in this video, the construction of them, how to prepare them. And then we'll also be looking at step number 7, journalizing and posting adjusting entries. My next video will be looking at closing entries in the post-closing trial balance. But this video, I'm doing steps 7 and 6. All right, so adjusting entries, what are they? They are internal transactions that we are going to make sure to bring accounts up to date. And these are accounts that aren't normally recorded or maintained like the other ones. We'll look at the examples. And you want to also recognize all revenues and expenses in the proper accounting period. And that's what we call accrual basis, accounting on accrual basis. There's also cash basis, but with my class, we only focus on accrual basis. So here are the items that we will look at being adjusted. Supplies and supplies expense. Supplies is one of those odd assets that most businesses do not take stringent recording methods to find out exactly what's going on with supplies. Often you buy, I'll give you, for example, for my school, we get paper clips, staples, staplers, folders, pens, pencils, erasers, ink cartridges, copier paper, and so on. Just a whole a large closet full of supplies, and anyone who works there just goes in and out of the supply closet and grabs the things they need. There's no a booklet there for you to sign off and say, oh, I took a permanent marker or an expo marker for my classroom, or I needed dry erase eraser or solution. You just take what you need and you leave, and it's based on the honor system. And I'm being honest, because supplies are one of the things that can be stolen from companies, but most companies are pretty lenient with their supply closet. You just go in and out of it, you take what you need. So therefore, what usually happens at the end of a period, and let's say for the sake of this PowerPoint, on a monthly basis, at the end of the month, you go into your supply closet and you just take a tally of what's left over and you make a proper adjustment. So throughout the month, if you had $1,000 showing that you in your supplies, but at the end of the month you show only 300, you need to make an adjustment to that particular account and show that $700 was used for that month, so you can bring that account down to the 300 really it should be. You also have prepaid expenses. So remember, I talked about that last video, and that you can pay your rent or advertising or insurance is a popular thing. So Geico, they normally will give you a better discount if you pay your bill every 6 months to a year. So a lot of companies do that. They'd rather pay their insurance up for a year. That doesn't mean that you just in December 31st, you claim the insurance for the year. No, you usually do it on a monthly basis. So you would do an adjustment so that you acknowledge the expense and then you bring down that prepaid expense, which is an asset account, holding that money until it actually has the expense occurred. Now, the third one is equipment. Now, I said that a lot of assets you're allowed to depreciate in value. So machinery, equipment, computers, a truck or a vehicle, all those assets are purchased for a company to run. And in time, those assets depreciate in value. They decrease in value. Matter of fact, a truck, as soon as you drive it off the lot, it now has decreased in value because you have an owner, you have mileage, you have wear and tear on the tires and so on. So assets depreciate in value, and so the government allows you to then allocate some sort of depreciation expense. You can use the government uses MACRS. For my book, we use the straight line method, so that's the one we're going to look at in this PowerPoint. And then to do an adjustment to it at the end of the month, you acknowledge the depreciation expense using whatever method you're using, and you put it also into accumulated depreciation. I will explain that. And the last one we're going to look at is salaries expense, and that is when the last pay period of the month might fall in between 2 months. So we'll look at that for this month we're in now, November of 2022. So how to analyze and adjust accounts. So supplies is an asset that's usually not regulated and or accounted for as other assets are. On November 1st, 2022, which happens to be today, I purchased $600 of supplies for my new business. Purchases of supplies, therefore, is $600. This is a new business. The supplies account will remain at $600 until the end of the month when I take inventory and adjust it. On November 30th, 2022, the last day of this month, I went into my supply closet and I counted up the inventory and I realized I have $100 worth of supplies in my supply closet. So therefore, that means supplies used was $500 and becomes an expense to the business. So therefore, on the 30th, the last day of the month, I want to acknowledge that supplies expense by debiting it $500. What account do you think would be credited? Well, obviously supplies, because we want to bring supplies is showing it's at 600, but it's not, it's at 100. So I would need to credit it. I would need it to bring it down to 100 where it really is at. So my adjusted entry for November 30th would be a 500, because that's how much I used for the month by taking a tally at the end of the month. And I therefore would debit supplies expense, acknowledging the supply expense for the month of November, and crediting supplies, bringing it down to its true value of 100, and therefore probably on December 1st, purchasing more supplies. The next one we want to look at is prepaid expenses. In this example, I said, on October 1st, I rented out a portion of a building from a family member. And for the first month, they gave me the rent free because I was just getting everything together. I actually opened up my business today on November 1st. So I'm sorry, did I say it? October 1st, I moved in, and then I opened up my doors on November 1st. So they gave me October free, and on November 1st, I gave them a check for $1,200. Because I want my rent is $400. It's family, so they're hooking me up. My rent is $400 a month, and I wanted to give them $1,200 for 3 months in advance. So that's what you call prepaid rent. I established my prepaid rent. Once I give them the check for $1,200, I established my prepaid rent at $1,200. And I decided to do my accounting on a monthly basis. So at the end of every month, that is when I'll acknowledge the rent expense. So on November 30th, I will say I used $400 for the month of November. And now rent will become rent expense for $400. I would debit rent expense $400 and I would credit prepaid rent because I want to bring prepaid rent down to the proper balance of $800. Now I only have 2 months sitting in my prepaid rent account. So let's look at the actual journal entry. So on November 30th, the last day of the month, under my adjusting journal entries, I would put rent expense gets debited $400, acknowledging the expense in the proper month, and crediting prepaid rent, bringing it down to the proper balance of $800. My next example is depreciation. I purchased a computer for $6,000 with a residual value of $1,200 and a useful life of 5 years. Now, the textbook that I use still use 5 years. I know the average useful life for computers currently is usually 3 years, but I kept this example at 5 years. And this company uses straight line method. And this is the formula for straight line method. It's historical cost, meaning the purchase value, minus residual value, meaning what do you think it's going to be worth to you at the end of its useful life? Meaning after 5 years, what do you think I could sell that computer for? So if I looked at the value of computers in 5 years from today, it might somewhere tell me, oh, would be around $1,200 5 years from now. So I went ahead and put, okay, 5 years from now, I'll be able to sell it at $1,200. And I said that I would be able to keep and maintain this computer for 5 years. So if I plug it into the formula, that would be 6,000 minus 1,200, which would be 4,800, divided by 5 years. And that means that every year I will depreciate $960 of that computer. And I do my accounting on a monthly basis. Therefore, I would need to take the 960 and divide it by 12 to allocate a depreciation expense on a monthly basis. So let's look at that. So if it's $960 a year and I divide 960 by 12, I get $80 a month. Therefore, every month at the end, the last day of the month, I'm going to acknowledge the depreciation expense, meaning I'm going to debit depreciation expense, saying I incurred depreciation expense, computer equipment at $80. Now, the other account that this money, this $80 goes to, is into an account called a contra asset. Contra asset. So contra, like contraband or contradiction, means you're going against. So contra asset account means you're going against an asset. You're going against its value. So I said that I purchased this computer at $6,000, but the minute I took it to my office and I plugged it and I started using it, it immediately lost value because I have an owner now. It has some wear and tear and it's been used. So therefore, if I wanted to turn around and sell it, I wouldn't be able to sell it for $6,000 anymore. Maybe if I had it for a month, I'd be able to only sell it for $5,500. So it depreciates in time. So I would want to be able to show a realized value of each asset. And by doing that, I'm using the straight line method, and I decided, okay, depreciation expense every month is $80. It's going to go into this contra asset, and the contra asset brings it down to that realized value I just spoke about. So as I said, as soon as I bring it into my office, it'll come down in value. Is there any set way to really be able to, determine what you should use for depreciation expense? It all depends on what industry you're in and what kind of wear and tear you're using on your assets. So you might want to do your homework to decide on what method you want to use for depreciation, but you want to make sure it's realistic to your assets in your business, in your industry. So for us, we're using straight line method, and so therefore my journal entry would be every month I would take $80 as depreciation expense, and $80 goes into my contra asset account, accumulated depreciation. Now, on this page, I wanted to show you this accumulated depreciation is shown on the balance sheet. So when I go down to assets and I have cash, accounts receivable, supplies, equipment, when I come down here to computer equipment, I'm going to see here's that's $6,000 computer equipment here that I purchased. And in this first month, I am going to take away less accumulated depreciation. So for the first month, I'm going to allocate accumulated depreciation of $80. Therefore, after the first month, I'm going to show a book value or a carrying value of 5,920. Is it completely accurate? No, it's not. We don't know what the number would be, but you have to pick a method and stick with it. Now I know I've talked about this with some of my classes. Like, is it set in stone? Set in stone? Do you have to? You can change it, at some point. But once you pick another one, you need to stick with it for many years. The IRS doesn't want to see your flip flopping every year. So if you did pick, let's say, straight line or MACRS, but you realize this is not for me, do your homework, and then whatever you do choose to change your business to, you're going to stick with that one because they don't want to see you flip-flopping every year on different depreciation methods. So does this make sense? Hopefully it does. So after the first month, this $6,000 computer I am now showing is valued at $5,920. And then this is what the journal entry would look like. So after the first month, I would debit depreciation expense, or every month I would put in this journal entry. I debit depreciation expense, $80, and I would credit accumulated depreciation, $80. Now in the first month, I would show accumulated depreciation as a value of 80. After the second month, accumulated depreciation would therefore be 160. After the third month, it would be 240, and so on. We would just keep adding the 80 until you finally got all the way to the 4,800. Now let's look at the last one, accrued wages. So I'm showing you, I'm choosing to use November 20th. And in the last week of this year, I know you can't really see this, but I'm going to tell you, that's why I wrote it here. The last week of this month on a Monday is November 28th. On a Tuesday is November 29th, and a Wednesday is November 30th. And if my work week and payday ends on a Friday, my work week is Monday through Friday, and on the very last week of the month, I would actually have Thursday and Friday in December. So for that last paycheck for November, only 3 days are allocated to my paycheck. So salaries accrued is when pay is earned in one period but paid in another. So going back here, I'm working this week, but I actually won't get my pay until December. However, on November 30th, the bookkeeper wants to do their end of month procedures and show all expenses for November. So therefore, they're going to have to do an entry so they can acknowledge these 3 days that all employees worked, but they aren't getting paid until November. I'm sorry, they're not getting paid until December. So for the last week in November 2022, John worked November 28th, 29th, and 30th, Monday, Tuesday, Wednesday, and then December 1st and 2nd of 2022. His pay is $175 a day or $875 a week. From his last paycheck of $875 for the month of November, $525 goes to the salary expense for November 2022. Because, let me show you the next one, he gets paid $175 for Monday, $175 for Tuesday, and $175 for Wednesday. So $525 of this monies goes to November 2022 of the $875 he gets for the whole entire paycheck, which he gets paid in December. So therefore, we would have to set up, and I say fictitious, but the only reason why I say it's a fictitious account because it's not really a liability. So we're going to use this fictitious account named accrued salaries payable, or some companies just say salaries payable or wages payable. And we're going to credit that account. So when we acknowledge this $525, which we would, and if you notice in all these adjustments, we're acknowledging the expenses. So when we debit the salaries expense, we're going to credit this fictitious account for accrued wages called either accrued salaries payable, accrued wages payable, or just salaries payable, wages payable, where we're saying, oh, we're going to have that liability because we're not paying it until December. We'll do another entry later to reverse it. So what happens is we need to put in this journal entry. We're going to take salaries expense and debit it $525. And then we're going to take salaries payable. Again, this isn't a real liability, but we're only doing this so we can acknowledge those 3 days that are actually getting paid in December. And we're going to credit it $525. And again, my last note to you is the reason why we do this is because you must acknowledge the expense in the period it was incurred. As I said, that is called accrued accounting. So let's see if we can figure this one out. G-Tree Bakery has a beginning balance of $200 of baking supplies on November 1st, 2022. During the month of November, the bakery bought $500 worth of baking supplies. So if you started off with $200 and you purchased an additional $500, that means baking supplies for the entire month was at $700, correct? So throughout the month of November, this bakery had $700 worth of baking supplies. On the last day of the month, November 30th, at the end of the month, the owner of the bakery goes into the bakery supply closet and tallies up the inventory. And for the end of November, they tallied up $100. So they started off with $700 throughout the month. At the end of the month, they had only $100. What is the appropriate adjusting journal entry for baking supplies? So as we saw with all of these, we always debited the expense. And in this case, we have to figure out what are we going to credit. We're going to bring down the value of baking supplies. Because remember, baking supplies right now show $700. But on November 30th, it's not at $700. It's at $100. So I would have to debit and credit how much? $600, because that's what was used, correct? So we're going to debit supplies expense $600, and we're going to acknowledge the expense of how much we used for the month of November in baking supplies. And then we're going to credit supplies $600 because we now have to bring the value down. It's no longer at $700. I realize at the end of the month I've used $600. It's at $100 now. So when I originally have a debit balance. Now when I credit it $600, it'll bring it down to $100. Here's another one. G-Tree Bakery bought a delivery truck for $20,000. The truck's residual value is $2,000. So therefore, the bakery will depreciate the remaining $18,000 over the next 5 years. So you would take $18,000 divided by 5 and say every year you would depreciate $3,600. So if I wanted to do this on a monthly basis, I want to allocate the depreciation expense on a monthly basis. I would take that yearly $3,600 divided by 12 and say, oh, I have a $300 monthly depreciation expense. So we would debit depreciation expense. Do you remember what you credit on the other end of depreciation? It's that contra revenue, I'm sorry, a contra asset account, accumulated depreciation. So in the adjusting entry for depreciation, you always debit depreciation expense and credit accumulated depreciation. And remember, as I showed you earlier, accumulated depreciation is shown on the balance sheet under the asset that it's tied to. So in this case, it would be for my delivery truck. And I would take that directly out of the value for the delivery truck so I could show a more realized value for that asset. So this is what the journal entry would look like. My depreciation expense truck gets debited $300 at the end of each month, and my accumulated depreciation truck gets credited $300. G3 Bakery decided to pay its truck insurance upfront for the whole year at a total cost of $1,800. What would be the monthly adjusted journal entry? So if it's $1,800 a year and we wanted to do it monthly, we would have to divide that by 12 and we would say, okay, there's a monthly insurance expense of $150. Now, with anything that this is prepaid insurance. With anything prepaid, that means you're going to acknowledge the expense on a monthly basis. So we would be saying every month insurance expense was incurred at $150, and we would take it out of the prepaid expense account. So let's say this is our first month, we show $1,800. At the end of the month, we really don't have $1,800 because if I cancel that account, I'm only getting $1,650 back. I'm getting $1,650 because for the first month, it actually was $150. So on my adjusting journal entry section, I would debit insurance expense at the end of the month, the last day of the month. I would debit that $150, and I would credit prepaid insurance to bring it down in value because it's no longer $1,800, it's now $1,650, so I'd have to credit it $150. Now, after I've put all my adjusting entries in my journal, I want to show what my journal will look like for after I've put all my adjusting entries. I also want to show you how it's going to look in a ledger. And then I also want to look at creating the income statement, statement of owner equity, and balance sheet. So let's first look at the journal. Now, when it comes to adjusting entries, you're going to skip a line. That's why there's this. So once you look at for the end of the month, this is May. Okay, so for May 30th, let's say I had my last transaction, I would skip a line and then I would write adjusting entries. Adjusting entries normally don't get descriptions because they're pretty self-explanatory, especially if it's ones that you're doing every month. So if I'm always doing supplies and prepaid rent or prepaid insurance, and I'm always doing depreciation of truck or computer, and I'm always doing accrued salaries, there's really no need for a description because this is something I do on a monthly basis every year. So an auditor would know exactly why you're doing these adjusting entries. So there's normally no need for a journal entry here. So we would skip a line, put adjusting entries, do each adjusting entry without any description. And then after that, you would skip a line and do closing entries. But I do want to look at the next thing, the general ledger. So if you remember with the general ledger, we never wrote anything last time when I talked about taking everything from the journal and putting into your ledger. When you looked at explanation, there was nothing there. However, now for each one of these adjusting entries, so let's look at the first one, computer supplies expense. I acknowledged $500 of it. So I debited computer supplies expense 500 and I credit computer supplies, bringing it down in value. So let's see how we would put this in the general ledger, the computer supplies expense and the computer supplies. So here's computer supplies. Now on the last day of the month, May 31st, I put under here adjusting because I'm letting the person who's reading this know this is an adjusting entry. In the post reference, I put GJ1 because this came out of general journal page, I'm sorry, 2, GJ2. So it came out of general journal page 2. That's where we would find it. And over here, we're crediting 500 because in this example, they started with 600 and at the end of the month, they had 100. So that seems to be a popular end of month balance for supplies. So we credit the 500 and now we show the ending balance of $100. Now let's look at the computer supplies expense. So computer supplies expense, this is the first month of business. So there's nothing there. And so we would only start off with a debit of 500 and an ending balance of 500 at the end of the month. So you see here adjusting. GJ2, we debited 500, so the balance ends with 500. We're going to look at closing next time. And then the next thing I wanted to look at, because we're going to look at the financial statements, I want to look at revenue. So the revenue for this company is computer repair fees. Remember Mel? I used that in the second journal. So over here we have computer repair fees, and then we show here that the closing balance of computer, or the ending balance for computer repair fee is $8,000, right, on May 22nd. So $8,000 is what computer repair fees has at the end of the month. Okay, so I just wanted to show you that there, and we'll see that here as well. This is our trial balance. Okay, so our trial balance is going to take all of the ending balances that you find in your ledger, and you bring them down here, and you look at your debit and credits and make sure they equal one another. Okay. This is something different. This is not the same example I just used because I couldn't find the trial balance, but I just wanted to note this one thing. There is no adjusting trial balance in QBO, in QuickBooks Online. So you would just run a trial balance, and then after you've run it, you can save it as adjusting trial balance. So once you've inputted all your transactions, and then you did your adjustments, your adjusting journal entries, then you would do another trial balance after that, and you would just simply save it as adjusted trial balance. I just wanted to write this note. So usually the first thing you do is look at your trial balance, but then you do your adjustments, and then look at another. We'll do that in my QuickBooks class, and I also have that in the posted QuickBooks class I have on this channel. Okay, so the first statement that I wanted to look at that we haven't looked at is the income statement. The income statement, or as it's known in QuickBooks Online, profit and loss. So for QBO, we call it profit and loss. Our profit and loss or income statement shows revenue minus expenses. So going back, that's why I said computer repair fees. That was $8,000. That was my ending balance. So we're going to take our ending balance and put it here in the income statement for my revenue. Then I'm going to list all my expenses, add them up, and give me a total operating expenses. Then I'm going to subtract these total operating expenses from the revenue to give me either net income or net loss. In this case, Mel has a net income of $4,900. Okay. The next statement we do is the statement of owner equity. So the statement of our equity starts with the beginning of the month. So in this case, we're doing May 1st. So on May 1st, we show what the value of Mel's capital is. It's $10,000. Then we take from the income statement the net income or the net loss comes over here. So whatever the last figure is from the first statement, which again is our income statement or profit and loss, is 4,900. This 4,900 comes over here. And so we're going to add net income. You would subtract net loss. But we always subtract withdrawals. So any withdrawals that the owner took out from the business gets subtracted here. And then in this case, we have an increase in capital because we have a positive 4,900, a negative 625. We get a positive 442.75. So we'll take this 4,275 and add it to the 10,000. And now for the end of the month, May, Mel Blast capital is at 14,275. So this right here is your ending balance of your statement of owner equity, and this readjusted. Now we make this adjustment taking into consideration revenue, expenses, and withdrawals. Remember we talked about it in the fundamental accounting equation. Under owner's equity, you have revenue, expenses, and withdrawals. They all go back into capital, and this is the process of that. So the net income represents revenue and expenses, and then the withdrawals, and we get either up, and you're either increasing or decreasing capital. In this case, we had an increase because we had a large net income. We had to subtract the withdrawals, but we're still increasing his original capital by 42.75, giving him an ending 42.275. And then now this figure goes into the balance sheet. So let's look at that. The balance sheet shows us assets equals liability plus owner equity. So on this side, we have all our assets. I know we can't see this, I'm sorry, but all our assets are listed here. And look, this was my computer. Remember, we purchased the computer at $6,000, but we have an $80 depreciation that we have to acknowledge. So this is accumulated depreciation, computer equipment of $80. So we bring that to contra asset. We subtract that from the asset, and now we have a more realized value of 5,920. We add that up to the rest of the ones, and this is what we get as our total assets. And so total assets has to equals total liability and owner equity. So we have we have accounts payable, and then our salaries payable. This is our accrued wages at the end of the month. And then we add that to the capital. This capital balance came from the statement of owner equity that we just looked at, the 14,275. And then when we add these two numbers together, this number should equal this number. So all you accounting students that are taking exams or doing projects with this, you need to make sure that your total assets equals your total liability and owner equity. And that ends this PowerPoint. The next one I'll be going over is closing entries, ending the accounting cycle, and then a couple of side topics.